Hey guys, welcome back to Father and Son Investing. Frequently we get some questions asking us our opinion on options. If you're not familiar with options, I'm going to cover how that works here just a little bit. So frequently we'll get our opinions on options, and usually the answer that I return is I'm not really in favor of them except for something called the covered call option, which I am in favor of. I'm going to go on to explain the covered call option, and then I want to talk with you about an ETF that actually specializes in covered call options. I also want to talk to you about the tax implications of that and how you can get around that, at least if you live in the United States. Stay tuned. We're going to cover all of that and more. All right, bear with me for those of you who really already understand options. There are going to be people watching this who don't understand it, and there will be some young investors who really might not understand it. So we're going to cover that quickly. There are two types of options contracts. There is a put and a call. If I am doing a put, that gives the buyer the right to sell the asset at a certain strike price. So the buyer of the contract can sell an asset at a certain price. If I'm doing a call option, the buyer of the contract can purchase an asset at a certain price. That certain price is known as the strike price. So when you see that on an options contract, that's what we're talking about, the future price at which a person can buy or sell the asset. Okay, how does that work then in real life? We're going to come up here to this little four square here. The buyer of a call option has the right to buy the stock. They want the stock to appreciate in value, and the buyer will pay the premium. A premium is just like it is for an insurance. Say on your home or your car, you're going to pay a premium, and if something happens, the insurance company is going to do something to make you whole again. Regardless, the company gets the premium. Now let's look at a put. The buyer has the right to sell an asset or a stock at a certain price, the strike price. They want the value of that stock or the price of that stock to go down, and the person who buys the contract is going to pay the premium. Just like with insurance. You buy insurance, you pay a premium, okay? Now let's look at the seller in this case of calls and puts. The seller then has the obligation to sell a stock at a certain price, the strike price. They want the stock to actually go down so that the buyer of the contract doesn't want to execute it, and the seller collects the premium. So I get to keep the premium if I'm the seller, just like if I'm the insurance company. And then in the case of a put, the seller of the contract has the obligation to buy a stock at a certain price, the strike price. They want the stock to go up or to stay high, and in that case, they get to collect the premium. Regardless, they collect the premium, but they don't have to buy the stock, and they make money by collecting the premium. All right, this doesn't sound so bad. Why would I not want to deal with these? We're going to take a look at this as if it's from a call option. That's what this graph shows. The buyer of a call option would buy the option at 58.5. Why is the break-even point out at 59 and not at 58.5? Because the person who purchases the contract has to pay a premium. So in order to make up the cost of that premium, they need it to go out actually beyond the strike price, and that's where we call the break-even price. Anything beyond that is just profit for the purchaser of a call option. Now what if I am the seller of this option? Okay, let's look at this. I get to keep the premium regardless. Once the price goes beyond the strike price, I don't make any additional money. If I bought the stock at 57.5 and it goes up to 58.5, I get to keep all of that. But beyond that, I don't make any additional money beyond the increase in the value of my stock and the premium. Okay, that's not so bad. Now, what if I don't actually own the stock? What if I sold this call option without actually owning the asset? Okay, that's a problem. That then exposes me to potentially indefinite losses. Why is that? Well, let's say that the steepness of this curve goes way up, way up, such that instead of, this shows it getting to $1, what if it got to $10 or $100 or $1,000? Well, the holder of the contract doesn't have to actually execute it until the expiration date. He has the option to execute it earlier than that, but he doesn't have to. So this potentially could get all the way up to $1,000 per share. Meanwhile, I have sold a contract that says that he can buy it from me at 58.5 cents. But in order for me to sell it to them, I got to go buy it, and I might be buying it at $10 or $100 or $1,000 per share. Those are huge, huge losses. That's my problem with options. A lot of this gets done leveraged. You could flip this on its head and be talking about a put. Now, there is some good downside protection to a put, and that is that the stock, when it gets to zero, doesn't go beyond that. But there's a way of multiplying your losses with that put if you don't actually own the asset, and that is if you have leveraged it. So you could potentially buy sell five times the contract of a put compared to the amount of money that you actually hold. So you could potentially have 5 times the losses all the way down. Now, of course, whether you choose to do this really depends on your risk tolerance and where you're at in life. I think I have a pretty good risk tolerance, but I don't have a risk tolerance so much for options contracts. There is one type that I really like, though, and that's called the covered call, and let me explain that to you, and then we'll talk about that ETF. Okay, this graphic here covers the concept of a covered call. At point A, I buy a stock for $100 per share. Then I go ahead and sell a contract for someone to purchase as a call contract, also for $100 per share. It doesn't have to be 100. I could set the strike price at 110 or 120. The farther out I set the strike price, though, really the less of a premium I'm going to get, because the odds that a stock will reach way out there is low, and thus the purchaser of my contract is not going to pay as high of a premium. So let's say I set it at the money, ATM, and it was for $5 per share. I've already made $500. Regardless, I get to keep the premium of $5 per share at $100 per share is $500. So let's say the value of the stock goes down to $95. Well, I still haven't lost anything. I have my $95 per share plus the $500 that I already made. So the amount of money, or the value that I still have, is still the same amount I purchased here at point A. Now, let's say the value of the stock goes up. It goes up to 110 or 120. Well, if I set my strike price at 100, I'm not going to get any more increases in the value of my stock, but I did make $500, so I have $500 of profit. What if I set the strike price further out at 110 or say 120? Well, then this line just goes up until my strike price, and then beyond that, it levels out and goes flat. So the QYLD Exchange Traded Fund, or ETF, which is essentially just a basket of equities or bonds or whatever the ETF chooses to hold, but some asset, a basket of different types of assets. This ETF then will buy the stocks in the NASDAQ 100, and then it will write covered call contracts for those same stocks that it just purchased. And it writes them at the money. Let's cover that quickly. This is just to help us understand these terms: at the money, in the money, and out of the money. If we're at the money, that just means that the price of the stock and the price of the strike price are the same. If something is $7,000 currently, and I set my strike price at $7,000, it is at the money, ATM, you might see that. If something is in the money and I am the buyer of the contract, meaning I have the right to purchase an asset, then it means that I'm already going to make money, even if I were to sell the contract like tomorrow. Okay? If something is out of the money, that means that it hasn't yet become profitable. So going back to QYLD, the way that it makes money for its investors is it buys the asset and the assets in the NASDAQ 100. It writes a call option for those same assets at something called at the money. The expiration date in this case is always at the end of the month. So anything that happens to the asset during the month until the last day really makes no difference. It depends on where the asset has gone up or down by the end of the month. It then takes the premium that it received for selling the covered contract, and it returns that back to its investors in the form of a dividend. Now, what does the dividend look like for this particular ETF? If we come down here to distributions, we see that it says the distribution yield is 12.56%, and the 12-month trailing yield is 13.08%. Now, the dividend changes month to month. It's not always going to be 12% every month. It might be 9% one month. It might be higher than that another month. Now, I mentioned that this particular NASDAQ 100 fund is very heavily weighted, top-heavy in information technology. In fact, it says it's 46.64%. And if we look just below that, we're also looking at some consumer discretionary and communications services. That makes up the bulk of this, with very small amounts of utilities and financials, etc. Why might that be important now? We've all seen in the past few days this massive tech sell-off going on. Now remember when we did the covered call strategy that if the price of the asset goes down, that I still get to keep the premium, and that gives me some downside protection. It might go down beyond that, but my losses won't be as great as somebody who doesn't have this covered call option. So in a time when the asset is decreasing in value, I'm covering some of my losses, and I also still get to keep the asset. So let's just reiterate that using some graphs here. In the case of a down market, like we're seeing as the price of all this tech goes down, the strike price is set at a certain spot, and now we catch it at this downward part of the cycle here, and we then get to keep our premium, we get to keep the stock. The price of the stock is less than it used to be, but we still made some money with the premium. In the case of a flat market, if the index price doesn't change, QYLD gets to keep the premium, and they also get to keep the underlying equities or asset. Now, the one place where you won't make as much money as your other people who aren't doing this strategy is in the case of an up market, right? Because I'm going to sell a contract that says I will sell it to you at this strike price, and then the price goes up. I won't get to make as much money as another person, but there really aren't losses going on there, and I still get to keep the premium. So how does this look in the case of a down market? Let's just look historically. We can see that the sort of bluish bar is the NASDAQ 100 and the orange bar is QYLD, and the losses are not as great during a downturn in the market. The unfortunate thing with this particular ETF is that if we flip this upside down during up times in the NASDAQ 100, the QYLD is not gaining as much as the NASDAQ 100. However, they're still collecting that huge dividend, which has been, in the 11 to 12% range. Now, here's another thing to keep in mind. Remember, this is a monthly dividend and not a quarterly dividend, and those dividends can be reinvested within the fund. So you start developing a compounding effect here as this 12% begins to compound and compound and compound and compound. So if one is going to hold this fund for a long time, a lengthy period of time, or potentially if you're looking for dividend income, if you're getting close to retirement, this is a fund that can continue to generate a very nice return. We're going to talk about the tax implications of this fund, and then I want to talk to you about a way that I really love of avoiding some of these taxes. The way that the returns on this fund gets taxed, at least in the United States, can get a little bit complicated. I don't want to make it too complicated, but just think of it as being two buckets. We have our bucket that is the options contract, and we have our bucket that is the assets, the NASDAQ 100 stock. We look at these two buckets, and they're each making kind of their own bits of money, and because of the way that's happening, things can get taxed in sort of a strange fashion. The long and short of it is that you're going to end up with some long-term capital gains and some short-term capital gains, and of course, in the United States, those get taxed at different rates. They also throw in there some return of capital, which essentially is not taxable, at least at the time you get the capital, but maybe sometime down the road. So the tax situation can get a little crazy. How can you get around that? Something that I really love is called a Roth IRA. This picture covers nicely the concept of a Roth IRA. It's from Napkin Finance. One can open a Roth IRA just like one can open a traditional investment account. There are differences in those. Investment accounts are going to be getting taxed. There are two types of IRAs in America, the Roth IRA and the traditional IRA. The difference between them, in a traditional IRA, one gets a paycheck, they contribute pre-tax dollars that haven't been taxed yet, that grows tax deferred, and then when one takes the money out, they're going to pay taxes on both the earnings and on the original contribution. So you're getting taxed. If you set up something called a Roth IRA, you contribute after-tax money, meaning one pays the tax on it when they earned it. That then grows tax-free for potentially 40 years if you set this up as a 20-year-old. Grows tax-free, and there are no taxes on withdrawals. No taxes on the earnings, and one has already paid the taxes up front on the contributions. This might be a great thing if you are not in a very high tax bracket. You pay your taxes this smaller sum, and that money grows fantastically for 40 years. Now, there are a few other nice things about a Roth IRA. One of the nice things is that you can use the contributions anytime. So it's a little bit like having a savings account. You can't take out the earnings until you reach 59.5, or there are some other ways that can happen. But you can take out your basis within this anytime you want. So it's a great way. It's kind of like a savings account again. For people, I wouldn't recommend that they do it, but in an emergency, at least you have some funds there that you're not paying money except for opportunity cost. There are some other nice things in there, although the tax laws in the United States are about to be changed, I think. You can look here on this graph and see what some of the other benefits are. Now, in the United States, if you make more money than is allowed for a Roth IRA or even for a tax-deductible IRA, there is a way to go about doing it. I have done this for several years now. And what one does is set up a traditional IRA. You're going to have to pay the taxes on that money if you're over the limit, but that's okay. You set up a traditional IRA, and then you can convert that to a Roth IRA. So we call this a Backdoor Roth IRA. You have to watch out for that pro rata rule. I'll let you Google that one, but if you have other IRA accounts set up, the government looks at this differently than you might when you try to do this backdoor thing. You need to look for that pro rata rule. And then you fill out a Form 8606 to let the IRS know that you converted your traditional IRA money into a Roth IRA money. You might owe taxes in that, depending on whether you've already had earnings. But the best way to do it is to, at the start of each year, put money into your traditional IRA. Of course, you will have already paid taxes on that. And immediately the next day, convert it over into your Roth IRA. It's not going to really earn anything, and therefore there's really not going to be any taxes during that one day. And you can do that every year. Backdoor IRA. And what does that mean? That means that this ETF that we're talking about, QYLD, will be growing its money at 12% per year without any taxes, and compounding and compounding and compounding. As I showed you earlier, this is particularly tech-heavy and consumer discretionary and consumer services. Those generally are not companies that pay a lot of high yields. What tends to pay a lot of high yields are utilities, REITs, real estate investment trusts. I really like those as well, but they pay some really nice yields. So if a dividend investor has a lot of exposure to utilities and REITs, and those take a downturn, that can cause some trouble. This is one more way of diversifying and getting yourself into a different sector in the economy and in the stock market, and still keeping that nice dividend going. All right, some of you are really going to have loved this. If you did, please give it a thumbs up. We really enjoy that. And some of you are going to think that this was a big waste of time or that this is a poor investment. I understand why you would be thinking that. If you're from that perspective, it's probably that you're thinking, hey, that when the NASDAQ goes way up and the price of this QYLD doesn't go at the same level, well, then I'm not making as much money. Think about Roth IRAs for yourself, and especially for a young person in your life. They just have to be earning some money, and some real money. They can't get it from $10 for mowing your own grass, but anything else, if they got a summer job or if they have running their own business, mowing lawns or whatever, they can put money into a Roth IRA when really they're paying almost no taxes, and that money will grow tax-free for the rest of their life. And again, they can get it out anytime they need it, at least the money they put in, not the earnings. Until next time, enjoy your investing.